Jeff, another company you and I both own and follow closely is the Trade Desk. On November 10th, stock's down. It's down 16, 17% or so. We'll talk about why the stock is down and where we view it right now going forward and how investors should be thinking about this stock.
Yeah, this is one that I follow pretty closely like you do, so I'm excited to talk about it.
Yeah, before we get into it though, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/the smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Okay, Jeff, I'm just going to share this on the screen. I want to talk about just real quickly where the stock is right now. Again, it's down 16% so far today. And year to date, it's still up pretty good. It's down from the high, right? It's down 30% or so from the high. Again, you look even further back. I think it's always useful just to take these looks back. And we go back over the past 3 years, really the stock is still down a pretty good bit from that kind of bubbly peak when we saw so many SaaS growth tech stocks that were down a ton. So let's take a look at earnings. I'm going to kick it over to you for that.
Yeah, the quarter itself really wasn't bad at all. They saw revenue growth of 25% year over year, and that's right where they've been for the last several quarters, and that's very respectable. So no noticeable decrease there. Unlike a lot of other companies which are seeing revenue decline, they're not. So that's good. Earnings per share growth was up 167%, million in free cash flow. All of like the things you'd want to see are looking good. So there's really nothing about this quarter in particular that is of concern. But as you and I discussed before we hit the record button, oftentimes what happens with a company's stock reaction is not so much the quarter that got reported, but the projections for the coming quarter. And I think guidance and also the fact that the guidance that they gave is flies in the face of what we saw with some other advertising based companies. I think there was some belief that after Meta reported and Roku and some other companies where the strength of the advertising market can really drive results, they all seem to see positives. And the fact that the guidance for Q4 was less than people were expecting for the Trade Desk, I think was just more surprise. I think people probably expected them to see some of the similar trends. So let's talk about that guidance, Jason. What was the issue there that got the market all spooked?
Yeah, it's a reminder, right? The market's always looking forward. We look forward with what we're expecting, and is the price for the stock today, does it make sense with what we can expect it to do for going forward? And definitely in case of messed up expectations, before I even talk about the guidance, I want to show the company's revenue run rates going back all the way to 2015, is they start highlighting the revenue growth rate. And you can see, and again, 2020, a bit of an outlier with the pandemic, right? Where all the companies pulled back on their ad budgets definitely during the first 4 or 5 months of the pandemic. And then growth reaccelerated, and then it started to decelerate again, right? 32% revenue growth for all of 2022. I think we're about 25% revenue growth so far this year. But their guidance for the next quarter was at 17%, Jeff, 18%? Is their their guidance was at
18% for revenue. Yep.
For the fourth quarter. So again, we're seeing a further deceleration that is certainly outside of what Wall Street analysts' expectations, a lot of investors' expectations were for the business. So Jeff, thinking about that deceleration of revenue growth, thinking about Trade Desk business, is this something that has you concerned?
No, honestly, it doesn't. I feel like if you take a step back and think about what the Trade Desk does, they are the biggest buy-side marketplace for programmatic advertising. So the more that we're going to be seeing commercials on streaming devices and our mobile phones and things like that, the more the Trade Desk is going to be involved. That hasn't changed. And yes, the advertising market will have its ups and downs. And I think, again, there was just some concern because some other advertising-based companies saw positive results. So the market was probably surprised that Trade Desk put up a little bit of caution. But taking a step back, those big fundamentals for the business have not changed. I'm not concerned from that standpoint. I think the issue, though, is that this is not a cheap stock. It hasn't really ever been. It's almost always priced for perfection. And when you have a company that is priced for perfection and there's anything short of what's perceived as being perfect, you're going to see a 15, 20 or more % hit on the stock. That's just like that's just as predictable as anything. So I'm not surprised the stock has fallen. I'm also not concerned from a business standpoint because the stock has fallen.
So here you go. Here's a common valuation metric used for these high margined, high return on capital sorts of businesses like the Trade Desk. 18 times sales. Again, that's a very high. It might look cheap for Trade Desk versus some of its past prices, but again, that's a super high multiple, 18 times sales. The thing though, this is the company that's been profitable for more than a decade. So I think it's old enough, it's grown up enough that we can look beyond just the price to sales metric, look at price to free cash flow. For example, you think about a value stock, you're going to pay about 10 times. A lot of growth stocks, you can get them for 25 or 30 times cash flows. So again, even with this discount, this sell-off today, still trades for 55 times free cash flows, which is a pretty rich multiple. And I think you're right. I think that explains the volatility. Jeff, same as you, I'm not concerned about the Trade Desk even close to it, but I want to talk about some of its competitive advantages and where it fits in the advertising space, and compare it and contrast it to, say, like Meta, you mentioned, is a good example. Alphabet, they have the ad inventory, right? They're selling the ad place. It's their walled garden, right? It's on their platform where they're selling that inventory that they have. That market has gotten better. And then you have other companies like PubMatic that they're fighting for the scraps, like whatever's left over that's not behind the walled gardens inventory. So that's where they are. But then Trade Desk it's in the absolute sweet spot, I think, with its platform, because it's not selling ads here. It's selling its service, right? It's selling what it does that's a value to those businesses, to the biggest ad buyers on the planet. All of the largest marketing and ad agencies work with it. They're partners with the Trade Desk. All of the biggest money spenders, name a big consumer brand, they're probably a customer client of the Trade Desk, and they don't pay. This is not a company that goes out there and scoops up a bunch of ad inventory and then marks it up to sell. It makes money on its service, the data that it provides to help these marketers leverage their ad spend, actually be able to measure how effective it is, and then generate better returns on their ad dollars.
If you want to use one of those big companies as an example, like Procter & Gamble, if you're the advertising marketing department at Procter & Gamble, you're going to the Trade Desk because they're going to give you the best analytics to know that the money you're spending to place advertisements, the data that the Trade Desk is going to give that huge company is going to be super helpful to their advertising department, so they know the efficacy of the money that they're spending on advertising. So yeah, they have an enormous role in this market. And again, as we see more and more advertising switch to streaming, where you and I, Jason, are going to get two completely different ads watching the same show because of what the Trade Desk knows about each of us individually, it's just going to drive value for all these companies.
Jeff, so you take all that and you put it together, and I don't think that the revenue decline, let me rephrase that. I don't think that the declining revenue growth that we're seeing for the Trade Desk is emblematic of any reason for concern. This remains the leader in its space, the most value add partner when it comes to analytics, when it comes to using that data to get the most out of it. It's still very expensive. I think that's another thing to remember. Investors should continue to expect volatility from the stock. I don't necessarily think this is some deep discounted buy on the dip sort of opportunity. I think the Trade Desk, you want to think about it, is probably the ideal buy in third stock. If you're interested in owning this business, maybe this is a good time to dip your toes in a little bit, add to an existing position, maybe start a small position. And then over time, the market may give you better opportunities to add. Because the bottom line is that this is the kind of business that's probably always going to be expensive, because they're probably always going to be very profitable and executing well. You don't want to wait for the perfect price, but also I think you should be careful about not jumping in too big, because you might get better opportunities down the road.